Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
You're looking at a market that's actually turning around, an unbelievable move. It's similar to what we saw yesterday. Also, the Nasdaq now up by 0.5%. Joining us is Henrietta Treyz, Managing Partner and Director of Economic Policy at Veda Partners. Henrietta, what the market seems to want to understand is if tomorrow is going to be a clearing event or the end of the beginning before the next phase here of turmoil.
Yeah, I mean, that's obviously the critical question. I see no indication that this is going to be a clearing event. I'll give you a couple of reasons why. Number one, we know that today the president instructed almost 3 months ago the major federal trade agencies, USTR, Commerce, and Treasury, to provide him with about 15 or more different reports about different components of our trade landscape, trade relations with 20 different countries. Not a single one of those reports has been publicly released yet. So the background to justify the forthcoming tariffs is something that you would expect to see publicly released, formalized in a Federal Register update, or even discussed with the media in advance of a publication. Should be all laid out if this is going to be clear cut and ready to go tomorrow. So the disarray that we're seeing, the sort of knives out reporting we're seeing for Howard Lutnick at Commerce, and the general disarray and lack of cohesiveness from the White House around this suggests that while we're going to get a lot of tariffs announced tomorrow and implemented at midnight, there's still going to be a substantial amount of uncertainty. I'm especially concerned about India, additional Section 301 investigations, what it means to pull out of the Phase 1 trade deal with China or declare them in violation, and how that impacts the tariffs we'll see on China, and obviously Canada and Mexico, which is maybe the most discomforting of all the tariffs, especially to the auto manufacturers right now.
Henrietta, maybe it's just me, but I haven't heard a whole lot from the U.S. Congress, either house, about their views on trade policies and potential changes and potential tariffs. Is that unusual?
It's not unusual, but it is, certainly notable, and I think should be relatively embarrassing for a chamber that used to pride itself on having authority over, tax policy and trade policy, and has been ceding those controls to the White House since the 70s, if not before. However, I will say they are going to hold a vote as early as this evening on the IEEPA tariffs against Canada. And there are a number of Republicans in the Senate who are telegraphing that they're going to cross party lines and vote against the president's declaration of national emergency against Canada, including Senator Collins of Maine. I wouldn't be surprised if, obviously, Rand Paul, who's a co-sponsor of the legislation from Kentucky, will be there. Chuck Grassley. Obviously, the farm state senators are the most exposed here. We know that the USDA is already talking about another bailout for farmers as we head into a global transformation of trade that will hurt them substantially.
Do we get the sense that if there is short-term pain for U.S. companies, that the administration is going to help subsidize it, which is really what we saw with farmers back in the first Trump administration? And is that kind of what the tax bill will be, or is it going to be something more beefy?
No, the tax bill should not be considered subsidization because it's an extension of the status quo, and it's so expensive already, $4.6 trillion just to keep things where they are, that you should not expect additional subsidization or tax cuts for either businesses or individuals. That is a point blank declaration from Senate staff that I speak with on Capitol Hill. I would go a little bit further and say the endeavor, they endeavor to cut the deficit by $1.5 trillion. My expectation is they ultimately come in at around $400 to $800 billion and more pay lip service to deficit reduction. But you cannot call it deficit reduction when you're simultaneously writing off a $4.6 trillion extension of the existing rates. So unless you consider, like many staffers do, the idea that providing certainty and permanency for individual tax rates constitutes stimulus, there will not be stimulus in this tax bill. So these tariffs are coming. They are tax hikes. There are not tax cuts coming.
Henrietta, can you explain the politics of this tariff thing here? I mean, the markets, stock market's down 9-10%. The dollar's trading lower. The markets just don't like the uncertainty, I guess, more than anything else. And the concern is that may slow down this economy, may push it into a recession, may cause some inflation. Historically, that's not been good politically. It's the economy, stupid. What's the political call here on behalf of President Trump and the administration?
The view from the White House is that they have a mandate. They have the House, the Senate, and the presidency. They won the swing states, and they have, successfully come back from a loss in 2020. So they are going as if this is something that all of America, and certainly their voters, are fully behind. The polls suggest that that's not the case. The lowest amount of support for President Trump comes on his tariff strategy. The American public is very aware that tariffs are not tax cuts, as the president has proclaimed, and they do not view tomorrow as Liberation Day. They view it as a scenario where we're going to see more tariffs and taxes, mostly because, of course, that is what is coming, and you can see it in the pull forward purchases at auto sectors, for example, or auto sales. So you have a pretty material disconnect between what the White House thinks it has a mandate for and what voters are suggesting they support. But on Capitol Hill, as you point out, the senators and the House members, the best that they can do, given President Trump's stranglehold on their voters and the incredible popularity that he shares, is that they have to go along with this now. And the best they can do is expect that the uncertainty is really the problem here. So once we get past tomorrow, you'll hear folks say 80% of the whole market downturn is because things are uncertain. It's much more likely that once we get past tomorrow, things will calm down. And then they're very optimistic that some of these tariffs on especially Canada and Mexico will start to come off over this summer in time for a turnaround going into the 2026 midterm elections, which is about 18 months away.
Is there any real data that points to the fact that that could happen?
Well, there's no real data on anything except for what's in Trump's mind on what could come and what might come off. But there is very real concrete data that I think keeps being ignored, which is that the president has imposed 20% tariffs on nearly $500 billion worth of goods coming in from China and 25% tariffs on all trade coming from Canada and Mexico on about 40% of imports. There's also an underreported narrative that I think we'll hear about in the coming months, which is that the disruption at the border is incredibly widespread and underappreciated because you have no one to go to at USTR that you can get recourse for if you want to, explain that you are USMCA compliant or seeking an exclusion. So there's these backlogs and confusion at the border taking place right now. The most concrete example would be when the president, via executive order, changed the de minimis rules and created such a logjam he had to pull it off. That's actually occurring at the border right now. It's being underreported, I think, in part because businesses are still trying to get exclusions and they're not able to speak with anybody, that they don't want to ruffle feathers in the anticipation of hopefully being able to get an audience in the months ahead.
All right. It's not just tariffs. At some point, Congress has got to fund the government and do all that kind of stuff. How should we think about the to-do list for Congress in the coming days and weeks?
There's so much there. Okay, so first things first, I would say the Senate budget that they're working on right now, I understand is going to include a $5 trillion hike to the debt ceiling. Now, that is an exorbitant figure. The last time we hiked the debt ceiling by any dollar figure, it was $1.2 trillion. So $5 trillion is shocking. This belies the reality that current policy baseline accounting for extending the existing tax rates is not free. It does matter to the Treasury. They do need a $5 trillion increase in the debt ceiling. And by the way, that's only to get through the 2026 midterms. That's not for Trump's full term, which is what I originally anticipated when I heard that number a month ago. So first things first, we have to deal with that. I expect it to be in the budget that we should see from the Senate as early as tonight. That'll come due in July. Secretary Bessent will give us an update on that in May. And then, as you point out, we do have a government funding bill that's going to be due September 30th. And I think that's where we're going to see the farmers bailout housed, aid to California wildfires. And depending on the scale and scope of this tax bill, it could be where you see an expansion of the child tax credit, an extension of the ACA subsidies. The reality is you need probably 10 to 20 Democratic votes in the Senate for any bill to keep the government open. And we all saw what happened to Minority Leader Schumer last go around. So I expect that September period to be really fraught with negotiations and a lot of tension, much of which we'll see play out as a result of the elections in Florida's 6th and 1st districts tonight. So that'll be a fascinating precursor to how this will all play out.
All right, Henrietta, thanks a lot. We really appreciate your analysis. Henrietta Treyz, Managing Partner and Director of Economic Policy at Veda Partners, which then raises the question, too, when we talk about a clearing event with all that in store.
Yep.
How could anything be a clearing event?
Yeah, that's a great point. Yeah,
at this point.
Yep. So, I mean, you're going to have tomorrow some tariffs. Hopefully that will provide a little bit of clarity for some members of the marketplace.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Right now, let's go to Tim Fiore, break it down. He's the chairman of the Manufacturing Business Survey for the Institute for Supply Management. Tim, talk to us about this ISM data. The manufacturing headline came in at 49, below the consensus and below last month.
Yeah, I think we disappointed here, but there's no huge surprise to this. I think the important thing is after I looked through all the data, I had to step back and say, what am I seeing here? And essentially what you got here is we're not sure what to do, and we're so confused. So if you look at the three elements, outputs, demands, and inputs, this PMI is being supported again by the input strength, which is really being driven by the tariff issue. So if you remove that out, this month would have been about a 48.3, just like last month would have been a 48.3. Our demand is still non-existent, really, because we're waiting to make investments. But I think the biggest story here in this month's report is that revenue is down this month. We're continuing to destaff, and it's all being driven by the uncertainty around the near term, the moderate term market development as tariffs get deployed. The good thing is tomorrow should shed a lot more light.
Mm-hmm. Yes, well, maybe. Tim, to that point, if this uncertainty persists, what's the end result to that? Like, is it more destocking? Is it more layoffs? Is it less investment? Like, or is it just deferred?
Well, so our inventory number will drop because we're probably trying to get 2 or 3 months worth of inventory in hand here to avoid the first hits of the tariffs. But I think it's becoming clear now that these things probably aren't going to go away. So what's going to happen is that it's going to limit our willingness to invest in capital. We are investing in inventory, as you can see, but we're not investing in capital goods to replace capital, to expand capital, R&D capital. That's really all on hold here until this whole thing settles out. Here we are one day before a major day, and we're still not sure of the details. So a lot of uncertainty here. The markets, the manufacturing does not like uncertainty. We're in the middle of the uncertainty here. Going to need a little bit more time to see where this goes. But in the meantime, think this would have been a 48.5, 48.3 if you normalize for normal behavior here, which right now we don't have. So we did disappoint. I think we underperformed 49. I think the average was supposed to be 49.5. Not a huge difference. We're not collapsing here, but we're still reducing our revenue and reducing our head count, which in the moderate term may not be good in any kind of recovery cycle.
All right, Tim, thank you so much for joining us. Tim Fiore, chairman of the Manufacturing Business Survey Institute for Supply Management. Again, the ISM headline data, the manufacturing data came in at 49. The consensus was 49.5. So anything below 50 means a contraction in the manufacturing economy. The ISM prices paid surged to 69.4, well above where folks were looking. And employment remains weak, and actually weaker than expectations. So some issues there in the manufacturing sector as well.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. And we also like updating you on the view outside of Bloomberg. Sarah Ponzik is financial officer at UBS Private Wealth Management. She joins us now from Boca Raton, Florida, for her take on the market. Sarah, you've private wealth, so your clients are in this for the long term. But uncertainty can last for quite a long time. How do you rethink a portfolio to take advantage of upside, but also protection in this weird time?
Uncertainty can last for a long time. And what's interesting is, although you can say ever since we entered the new year, ever since the new administration took over, there's been uncertainty. It really hasn't been that long. It's only been a couple of months. But I think we can all agree it feels like a lifetime. And we have certainly seen it affect sentiment in sentiment surveys and also in, sentiment from our clients as well. Plenty of calls, plenty of emails. We're having conversations every day. But as to your question, Alex, of how do you think about this in terms of long-term portfolios and rejiggering portfolios? I think at the end of the day, we all have to understand volatility is here to stay. It's not going away. It's not as though tomorrow is Liberation Day. We're going to find out exactly what's happening with tariffs, and all of a sudden it's going to be smooth sailing from here. That's not the case. There's still going to be a lot of back and forth, a lot of ups and downs in markets, a lot of intraday volatility, and we have to get used to it. But something that I do think is very important for people to understand here is that in the past, 10% corrections, which is just about where we are on the S&P 500, have been great entry points into the stock market. And yes, you have to have a very strong stomach and be able to weather the volatility as it continues. But if you look at if you would have phased into the stock market at a 10% correction on average throughout history, you would have been well off into the future.
What are your clients doing, Sarah? Are they going to cash? Are they buying the dip? What are they doing?
So we've had some clients ask about going to cash, but that's not necessarily our recommendation at this point in time. One, I also think it's important to point out, if you're someone who's an investor and you are well diversified, you're also diversified in high quality bonds, some private investments like private credit, private equity. You're not only invested in tech in the market. Yes, it might be a significant part of your portfolio, but that's not your only investment. I think a lot of people might be surprised to understand that if you look at your portfolios year to date, you're maybe flat to down 2%. We really have not seen big moves yet to the downside that would really qualify as something extremely scary or extremely extreme. So when you think about the flip side, if you're going to go sell investments that you've held for a long time, go to cash, one, you're probably going to be facing a big tax bill next year because you're going to be taking realized gains at the end of the day. And no, you don't want the tax tail to wag the investment dog. You don't want to be the only reason you don't do anything. But it's more so investors and clients of ours who have had cash on the sidelines and who have been waiting for an opportunity. It's more so you take advantage of the stock market, you take advantage of this volatility, you get your cash to work slowly, and you also, do a risk assessment. If you're someone who sees your portfolio down 2% year to date and you're freaking out, maybe you have too much risk in your portfolio, and that is a reason to de-risk.
It's such a good point. The other side of it is if we see rates a little lower, a little higher for longer. And there's obviously a debate for that because we're seeing a big bid into the bond market. Goldman Sachs now sees 3 cuts for the Fed this year. But if we don't get that because there is inflation and it's stickier, do you need to diversify more into higher yielding products?
Well, it gives you the ability to honestly sit in cash or buy bonds for longer and lock in interest rates. I know so many people have been talking about, locking in cash rates for really the past year and a half because the expectation where rates were going to come down, and rates just didn't come down as quickly as expected. They've been, pretty tough in staying where they are. So if you're an investor who still has plenty of cash, it's giving you this opportunity to lock in yields further into the future, buy quality bonds, and make sure you do lock in yields before rates come down. Our economists are of the view that, Fed Chair Powell has said that he expects any inflationary pressures from tariffs to be more so, I don't want to say transitory because everyone hates that word now after a couple years ago, but not long-standing. And that if there are more so pressures on growth on the economy, if there are concerns about deteriorating growth in a recession, then our economists are of the view that the Fed, even with tariffs in place, would probably start to cut rates at that point in time too.
Sarah, dividends, are they important in the UBS kind of equity allocation?
They are. I would say dividends are certainly important, especially if you are an income-focused investor. I think the problem with solely focusing on dividends, there are some investors who just think, okay, I want to focus on equity income. I'm only going to invest in stocks that give me the highest dividend rates. A lot of times, those stocks, as you know, are value companies. And what's happened over the past 5-10 years, frankly, is if you've only invested or focused on that part of the market, is you haven't been invested in the very companies that have driven much of the gains over the last 5 to 10 years, being big tech and growth companies. So yes, I think having value in your portfolio is important, especially if you're an income-oriented investor. Looking for different ways to get income in your portfolio and not just from the bond market is very important. But I think you also want to be very careful in not focusing too exclusively on dividends, because if you had done that, you would have underperformed the S&P 500 pretty significantly, over the last cycle.
With the exception of the last 3 months, where value actually beat growth.
Yes, with the exception of the last 3 months. But I'm still not counting growth out and counting tech out. We still see the long-term growth potential of tech and growth. We don't think that what we've seen over the last couple of months is, a death knell to these mega cap tech companies. Oh my gosh, they're no longer what they were. We rather see this, as an opportunity to right-size exposure if you've been underexposed all these years.
Yeah, Sarah, great stuff. Really appreciate it. Thank you so much. Always good to get your perspective. Sarah Ponzik, financial advisor at UBS Private Wealth Management.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's stay on the topic of global autos. Steve Mann joins us, Global Autos and Industrials Research Analyst for Bloomberg Intelligence. Steve, what are you telling clients about the impact we may see tomorrow from President Trump and tariffs on the global auto business?
I've been telling clients that I think we're pretty much done for auto tariffs for now. I think the big thing that's going to come up next is really on how parts are going to be taxed going forward. And it's a big chunk. We had a report out there today. Tesla, even though they make a lot of cars here, but about a third of their parts actually are imported from elsewhere, mainly low-cost country like Mexico. And then surprisingly, Ford Motor Company does build a lot of cars here in the U.S., but they only have some 30% content that's actually based in the U.S. So lots to come on the auto parts section of the tariffs.
Yeah, so let's just understand that a little bit more. So you have the actual whole imported car versus the car part. And the whole imported car stuff should happen tomorrow or Thursday, whereas the car part is a May thing. Am I getting that relatively correct?
Yeah, that's right. So it could be really huge. For example, I was just talking about Ford, right? Anything that comes in from Mexico, for example, the Mach-E, which they're losing tons of money on already, comes from Mexico. And then, if on top of that, the parts are actually coming from Mexico or any other low-cost country, that could actually lift the price of the vehicle even higher.
So are the U.S. automakers, is this going to benefit them? And if so, how and to what degree? I'm unclear here.
Well, I mean, it's philosophical. There's, I think, debate on both sides. Automobiles are high value products. There's no argument against that. And, the design of the vehicle, the production of the vehicle, the manufacturing of the vehicles creates a lot of jobs in the U.S. In the manufacturing alone, if I'm quoting some economists, every job that manufacturing creates another 0.4 jobs, peripheral jobs for that, to support that manufacturing. So it does create a lot of jobs. It does create a lot of innovation. Example, we just had Rivian on. A lot of these pure plays like Rivian, Tesla, they make a lot of the high value components in-house and in the US already. And that has created a lot of innovation around cars and around how to make cars in a cheap way, less expensive way. I think there's debate, right? A lot of the legacy automakers have, outsourced that manufacturing to low-cost country. And maybe that's why they're facing a lot of the competition around the world where they can't really build cheap cars cheaply to the masses.
Is it possible that some of the winners are actually going to be other foreign companies? Like we were talking about, Paul just leased a hybrid that was built either in Ohio or where was it? Virginia?
Somewhere
south.
U.S. based.
U.S. based. So, but it's a Honda. You can make the same argument for Toyota. Like, are those cars actually going to be the bigger winners here?
It could be. Like Japanese, if you look at potentially increasing prices for consumer, from an automaker's perspective, I think the Japanese are in a better position because there's still a lot of demand for their vehicles. Their inventory is relatively low, around 30 days to 40 days of sales, versus the average industry is like 70 days up, and some automakers are over 100 days. So in terms of pricing, I think the consumers will be willing to pay a little bit extra. And so Honda and, examples of Honda and Toyota may be able to get the consumers to absorb some of the higher tariff costs.
Have we heard any U.S. auto manufacturer announce plans for new factories, or they're going to add jobs? What have we heard from the U.S. manufacturers?
Not yet. I think there's a lot of discussion on, can we, with Trump about not taxing parts, certain parts, auto parts, but we haven't heard of reshoring. But, we've also had a lot of analysis. We've done a lot of analysis on reshoring. It's going to be a huge cash flow headwind for the automakers. If the automaker have to build a greenfield plant back in the U.S., that could cost upwards of $4 billion just for one plant. So that's humongous. So we haven't heard. I think the automakers are hoping that these tariffs don't last forever. But I'm sure in the boardrooms they're thinking about the contingencies around how to manage that capex, and probably asking the administration for financial support if they do have to bring back a lot of that manufacturing into the U.S.
All right. We really appreciate it, Steve. Thanks so much. Steve Mann, Bloomberg Intelligence Senior Autos Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.